Today, I'd like to talk with people about the revolution that we are experiencing in the financial markets. It's absolutely incredible that trading costs are extremely low. It used to cost people 2% just to buy and sell a security, and now it could be as little as a penny. So we're really in an opportune time for taking advantage of these new kinds of financial instruments that really didn't exist before the 21st century. I'm going to be talking about the Muscular Manifesto, which is my first column that appeared in StockCharts.com last week. And we're going to go through some of the points that I think people need to know about. We have an incredible audience of people out there. The number of people who are trading on the internet is supposedly growing 40% a year. And more people are coming on. More and more people have wealth, have accounts that they need to manage, but they haven't ever taken a class in how to manage it. Of course, StockCharts.com is a great way for people to learn how to manage their accounts. And so let's look at who some of those people are that we're talking about out there. There are more than 100 million different accounts that people have in the English-speaking countries alone that are 401ks, IRAs, or similar tax-deferred accounts, whatever the name might be. In Great Britain, they're called ISAs. In Canada, they're called something else. So if we look on the map here, obviously, the US and Canada are great English-speaking countries, but also the UK, and surprisingly, the Scandinavian countries have a very high penetration of people who are speaking English, 70%, 80%, according to this chart, which is from Wikipedia. Australia and New Zealand, of course, have numerous, mostly English-speaking people, but also India shows up as having 10%, 15% of its citizens who are able to converse in English. So if you look at this vast English-speaking audience out there who can take advantage of stock charts and who can take advantage of my own newsletter, my own website, there are just hundreds of millions of people who are affected by the opportunities that we have now to invest and trade in the market. When we look at the situation in the market, we find difficulties. It's been shown in numerous studies that trading is something that our minds are not particularly good at. If we were going to be playing against one of the chess grandmasters of the world, would we choose our own moves by guesswork, or would we use a supercomputer? It's been shown over and over that computers beat the best human game players in not only chess, but also in Go, also in Jeopardy, which is the trivia game on TV. Studies show that fewer than 2% of day traders make consistent profits, and that means they are profitable in one calendar year and in the next calendar year as well. It's a difficult thing. It's not easy. People look at the market as though it's easy to trade. It's something that our minds are not ideally suited for. So how can we take advantage of the markets that are presenting opportunities to us? The type of portfolios that the mass of people have been instructed to use for the past 40 years are called lazy portfolios. These are portfolios that have index funds, whether they're mutual funds or exchange-traded funds, that track a particular market. It's been shown that index funds capture 99% of the return of any market that you might be interested in, whether that's U.S. stocks, developed country stocks, emerging market stocks, and also other markets like commodities, precious metals, bonds, and real estate. So the people who could benefit from a new approach to using today's index funds and today's extremely low trading costs, if 2% of traders make consistent profits every year, that means that 98% do not. They might be interested in an approach that uses a gradual asset rotation towards those assets that are in uptrends and away from assets that are in downtrends. So in the top half of this screen, we see traders who may be making profits, may be making losses. More than 85% of intraday traders make losses. over any given 12-month period. It's a difficult thing for our minds to grasp, that we might not be able to control our emotions, control our opinions, and trade in a way that's going to be consistently profitable. In the bottom half of this screen, we see people who are perhaps managing their 401k plan or their IRA or their Roth. And those two kinds of people, the traders who aren't really convinced that they are grandmasters of trading, really, the 2% who really make consistent profits, and the people who have very different trading needs, who have 401ks and IRAs, those 100 million households out there need something to educate them, to train them, to help them along with how to manage their portfolios. The reason it's so difficult for us to manage our portfolios by ourselves is the way our brains have evolved over tens of thousands of years. When we are in some kind of a logical situation, our prefrontal cortex on the left is in control. This is the logical thinking part of the brain. But when we've experienced a financial loss, control switches over to the amygdala, which is on the right half of the screen, a smaller, more primitive area of the brain that's in charge of fight and flight. The amygdala makes bad financial decisions. It's been shown again and again that when you let your fear center make decisions, you are going to make decisions that are explained to you by your verbal center as being logical and correct, but actually are poorly thought out. One study showed that traders buy stocks that go up 5.7% in the next 12 months, but the stocks they sold to get the money to buy those stocks went up 9%. So what we bought went up 5.7%, and what we sold went up 9%. Our opinions fail us. They trick us into thinking that we're making good decisions when in fact we may be hurting ourselves. We may be giving ourselves long-term performance lower than we would like. Other studies show that investors who make fewer trades make more money in the market than investors who make more trades. Now, of course, this doesn't apply to the trading geniuses. You have people who are truly inspired, truly make the best decisions, and really are the grandmasters of the market. Those of us who are just average may not benefit from that kind of brilliance that you see from the real stars of the trading world. In this graph, we see that the 1/5 of traders who made the fewest trades actually outperformed an index fund that tracked the US stock market. As people made more and more trades, not only is their amygdala making them make bad decisions that they're not aware of, but they're also incurring expenses. The expenses may be small, they may be a few fractions of a percentage point, but that still adds up over the course of a year. And anything that you spend on expenses, of course, this year is money that's not going to compound in your favor in years to come. This kind of bad opinion about trading shows up in what's called the behavior gap. So this slide shows one study from Charles Rotblut of the American Association of Individual Investors. What if we took an average individual, a person who doesn't pay too much attention to the market, but definitely takes an interest when they see that the market is crashing, when the market has entered bear market. So this individual has an index fund holding the S&P 500, but on December 31st of a year when the market was down more than 20%, that individual switches to cash. They stay out of the market for the next 12 months before finally getting back in. That would have put them in cash at the end of 2002, and it would have put them in cash at the end of 2008. Unfortunately, that is a poor decision. You're buying high and you're selling low. You're selling when the market is down. So this individual, just by making those two decisions, actually hurt his or her performance by 2 percentage points. What we call the armchair investor, who doesn't really pay attention to the market and doesn't keep up with the market, only made 3.4% annualized. If a person had stayed with the S&P 500, they would have made 5.4% annualized. That's your 2 percentage point behavior gap. Now, it's difficult for people to stay with any one asset class like the S&P 500. the index is very crash prone. Who would have wanted to stick with the S&P 500 all the way down through the dot-com crash when it was down more than 40%? And not very many people would want to stay with the S&P 500 all the way down to the bottom in the global financial crisis when it was down more than 50%. For this reason, lazy portfolios are hard for individuals to follow. The lazy portfolios, which just keep the same position all of the time, year after year, expose people to these huge losses. Equities crash, and even bonds go down. Today, when we have a rising interest rate environment, we may find that bonds are not going to be a safe place for people to hold their 401ks, hold their IRAs. The opposite of lazy portfolios are muscular portfolios. What I've found and what is documented in the book Muscular Portfolios is that when you have a diversified portfolio and you check your portfolio once a month, you use asset rotation to move your portfolio away from assets that are in downtrends and toward assets that are in uptrends. You avoid the crashes that the S&P 500 subjects individual investors to about once every 10 years. In this simulation, which is by the quant simulator produced by Mebane Faber, the author of the Ivy Portfolio, we see a 43-year period. Of course, ETFs didn't exist in 1973. Most mutual funds weren't index funds in 1973. But we have to use something to show ourselves if the markets continue to have bull markets and crashes in the next 4 decades, like they have for the past 4 decades, what would have happened if we had had low-cost index funds like we do today, and we had low trading costs like we do today? In this case, we see that by having a diversified portfolio, holding at least 3 different asset classes at all times, and by making a gradual change in our portfolios once a month, looking at what is in an uptrend and what's in a downtrend, and gradually shifting from assets that are in downtrends to assets that are in uptrends, we see 2 portfolios that are documented extensively in the book. The Mama Bear portfolio, which holds 3 asset classes and makes a change only once a month, and the Papa Bear portfolio, which holds 3 asset classes and makes a change only once a month. These portfolios are designed never to lose more than 20% or 25% in even the worst market crashes that we've ever experienced. That is designed for the people, the 100 million households out there who have IRAs, 401ks, and similar kinds of savings programs, so that they never experience the fear and the crashing that the S&P 500 exposes people to about every decade. In this 4-decade period here, you can see that we had a 40% loss on the S&P 500 in 73, 74, 30% loss just in the 1987 crash, 45% loss in the dot-com crash, and more than 50% loss in the global financial crisis. By contrast, you had losses that were no more than 25% in this very severe 1987 crash, and no more than 21% during the financial crisis by the Papa Bear, only 18% down by the Mama Bear. If people can tolerate those kinds of pressures, they'll do better than the market because they're not losing half of their money in the market. That is where you really have a severe hit to your long-term performance. Now, lazy portfolios are an example of passive investing. Day trading is an example of active investing. What we're talking about now in the 21st century with very low-cost index funds, very low transaction costs, is mechanical investing. You pick a computer formula that has been shown to take advantage of diversification and take advantage of momentum in the marketplace. You follow that computer formula faithfully. Just as you were playing a chess grandmaster, you would take the moves of the supercomputer, make the chess moves that it provided, and not use your own mind to make guesses. We have a need to go back in time, quite a long time, to get track records that we consider to be reliable. Mark Hulbert has done studies of more than 3 decades of financial advisors who he has published in his Hulbert Financial Digest. He found that a strategy that was in the top 1/4 of all performance for 1 year or 5 years or 10 years had no statistical significance. You did not see those strategies being in the top 1/4 of performance in the next 1, 5, or 10 years. They tended to drop down into a lower performance category. On the other hand, those performances that had been in the top 1/4 for 15 years were more likely than chance to be in the top 1/4 in the next 15 years. We need to have long track records. We need to look at complete bear bull market cycles, which average about 8 years, 10 years. So a 15-year period essentially has 2 bear bull market cycles. That gives us information that we can rely on, that maybe we have something here that is statistically sound and is not just a flash in the pan. The short-term strategy of switching from one type of investing to another year after year even affects professionals. The pension funds, large institutions who hire outside money managers, 100% of them will terminate an outside money manager if his or her performance underperforms a benchmark for as little as 1, 2, or 3 years. What they don't understand is that you need much longer periods of time to measure people's performances. The financial institutions that let go the people who had underperformed a benchmark in the past 1, 2, or 3 years, the outside money managers that were hired to replace those fired managers, the fired beat the hired. So if they would have kept those same managers, they actually would have had a better performance than firing them and getting the new outside managers. This is a way in which we see how short-termism can hurt even the performance of people who are financial professionals. Now, that all seems a little bit discouraging. I don't want people to think that we're completely pessimistic. The S&P 500 is a number, but it's not a number that's impossible to beat. It's not like the speed of light. It's something that simple strategies can outperform the S&P 500 over long periods of time. This chart is from StockCharts.com, showing 3 different indexes that have beaten the S&P 500 over a period of the last 18 years. So this red line is the S&P 500. These are all index funds, the SPY for the red line. And you see how the red line is the lowest line on this chart. It's been beaten quite significantly by the Russell 1000, which is the 1,000 largest companies in the US, much more diversified than the S&P 500. That's the blue line, and it's beaten by the Vanguard Total Market Index, which is more than 3,600 stocks. But really, the champion of the past 18 years has been the Dow Jones Industrial Average, the dowdy old 30 stocks that are in the Dow Jones Industrials. And that has outperformed the S&P 500, not just for the past 18 years. We can't go farther back than this because we're using real index funds here, not the index itself. But the Dow far outperforms the S&P 500 over long periods like this because it has a low turnover, it has a momentum factor within it, choosing those stocks that have done well and are expected to do well in the future. Other people who have the ability to outperform the market include the managers of university endowment funds. This picture is Yale University. Its performance was 12% annualized in the 17 years ending June 2015, the same period that the S&P 500 returned only 5.5% annualized. This is true of other university endowment funds. Princeton, Stanford, MIT, they have outperformed the S&P 500 over long periods of time, 10, 15, 20 years, not by day trading, not by rapidly moving in and out of stocks, but by holding a diversified portfolio and using the rule of momentum to move more of their assets into asset classes that are going up and keep out of asset classes that are going down. It's not at all impossible to beat the S&P 500 as these university endowment funds have shown. The same strategies that they use can be used by individual investors without becoming day traders, without incurring the costs and expenses of trading every day. You can do this even in a 401k or an IRA, and most 401ks in the United States prohibit account holders from trading more often than once a month. So muscular portfolios are a solution to those people who have difficulty even buying stocks in a 401k, most of which prohibit buying stocks and only provide mutual funds and ETFs. Lazy portfolios are really what we're suffering from in the market for people who manage 401ks and IRAs. They have been advised just buy 5 or 6 or 7 different types of assets using these index funds and hold them forever. By developing muscular portfolios and finding portfolios that have been developed by experts like Mebane Faber, the author of the Ivy Portfolio, and Steve Lecomte, the CEO of CXO Advisory Group, we can show people how they can manage their money and achieve financial freedom. They can make enough money just in their 401ks and IRAs that they can quit their jobs and do whatever they like. We need to be careful about assuming that things that might have worked in the past in academic studies will work in the future. We see from this study by AQR that when academics publish white papers on the small cap effect, where small cap companies outperform large cap companies, most of that outperformance disappeared soon after the papers were published. So on the left, the small cap factor was outperforming large caps 7% a year. After the publication, that almost entirely went away, less than 1% outperformance after the publication of those papers. The same is true with value. Do value companies outperform growth companies? If you measure book to price, almost all of that effect went away after the publication of those papers. If you use a blend of value factors, only 2 percentage points of outperformance are left. However, what AQR found is that the momentum factor continued to mostly work even after it has been published in 1993. So 25 years later, we're still finding that you can get some big improvements in your portfolio by taking advantage of momentum, meaning which asset classes are in uptrends and which asset classes are in downtrends, and gradually shifting your portfolio accordingly. What we've done with the website muscularportfolios.com is post the ratings of the inexpensive index funds as how they are doing with their momentum today. This is the Mama Bear portfolio. Its rule is how well did these index funds perform in the last 5 months? And the Papa Bear uses a different formula, which is how did these asset classes perform in the last 3, 6, and 12 months averaged. This is something that's absolutely free. I think there are going to be dozens of websites that pop up that start showing these statistics absolutely free. We are going to take away a tremendous amount of business from the giants of Wall Street like Goldman Sachs and Morgan Stanley and Merrill Lynch. They just will not be able to keep charging their 1%, 2%, 3% fees per year for advice which you can get for free on the internet. So at this point, why don't I wrap up and take any questions that you might have?
Yeah, we actually did have 2 of them. I don't know if you wanted to answer them now, Brian, or if you want to prepare them for the end of the segment, but let's see here. We had, where did the brokers make up for the loss they incurred in this new price commission reduction that you've been talking about? So how are they making up for that? Do you happen to know?
I think the stockbroker industry is facing a tremendous amount of pressure. The internet has put a lot of travel agents out of business. There used to be thousands of travel agents, and now there are only a few. You can go to a website and get a plane ticket or buy a hotel room, and you don't need a travel agent anymore. That same process now is happening on Wall Street. We are going to see a lot of people losing jobs with high-priced advice that simply is not as good as you can get now on the web for free.
Yeah, I totally agree. All right, I have one more so far. Are you familiar with the John Bogle method of index investing, and what do you think of it if you are?
John Bogle is one of the 3 experts who are profiled in the book, Muscular Portfolios. We look at this as having 3 bowls of money. Here we have Goldilocks, who stumbled into a dark room. She sees on a large oval table 3 bowls of money. The one on the left is labeled the Baby Bear portfolio. That is a clone of Jack Bogle's own strategy that he has been promoting for more than 20 years of just buy 2 simple index funds and rebalance them once a year, and you will do as well as the S&P 500, which we show in the book. The middle bowl is called the Mama Bear portfolio, which we saw on that chart, that involves making a slight change in your portfolio once a month and not making more changes than that, not incurring the costs of rapid trading. The largest bowl is called the Papa Bear portfolio. That is the portfolio that we have found has the best chance of beating the S&P 500 over long periods of time. That is what we have documented is what is it that Jack Bogle is recommending that people do? What is it Steve Lecomte recommends? What is it that Mebane Faber recommends? They have really pioneered this new era of index investing.
All right. And that was the only other question I had in the room. I don't know if you had any yet, Tom, but I'm going to pass it to you.
Yeah, I think what we'll do is we'll go ahead, and I know there's a poll up, and I think this would be timely to see how everybody responded to the poll. How often do you change your positions? And about 1/3 say once or twice a week. Pretty close. I mean, another 28% once or twice a month, and then 26% say less often than once a month. So mine are once or twice. I would be once or twice a day.
Yes, I was going to say, I knew what your answer would be.
I couldn't answer. I don't have.
If I could jump in here. You have about 54% of the people saying they trade only once or twice a month, or less often than once a month. That's about more than half of the people who are watching this program on StockCharts are not trading every day. They're trading more gradually and hopefully doing better.
Yeah, I have to clarify. I mean, I do a lot of trading, but I don't get into a stock expecting that I'm going to trade it in and out in the same day. I mean, normally I swing trade, and so I normally am looking to hold for anywhere from a few days to a few weeks, I would say. And I didn't see that the bottom one once a day or more. I read it differently. I was thinking it was less often, but I guess that 13% category down there would probably be me. I do a lot of trading.
Yes, I'm in that 50% that you were talking about, once or twice a month, less often. I'm more of an intermediate term trader. So typically that would be my answer. Of course, I have done everything on this. So at one point or another.
Yeah, I would also say the volatility index impacts the frequency of my trading. When the volatility index is on the rise, I just think the risks are too great in the market, and I tend to just tuck my tail between my legs and kind of sit back and watch the market for a while, which is what I did throughout much of October. But when the VIX is coming back down, and I know a lot of traders, a lot of folks out there who like to trade frequently like that high volatility and those wild swings. But to me, it just creates a lot more risk that I try to avoid. I don't know. Does that come into play at all for you, Brian? Do you look at all at the volatility index, the VIX, and these, like what we just went through in October, or you just stay the course?
The remarkable thing that behavioral science has found is the less you trade, the more money you make. And the academics have shown that momentum is really a very strong predictive factor. So I would ignore volatility. I would ignore the VIX. The idea that you can know today what 3 index funds are going to do the best in the next 30 days is absolutely revolutionary. This is something that we can share with people all over the world, and it's not ever going to become overused because the mass of people are always going to be buying when the market is exciting and selling when the market is scary. So they are doing the opposite of what we're doing, just following this simple momentum trend.
Okay, gotcha. It's always a pleasure having you on the show. Again, I just want to thank you for coming on, sharing all your knowledge with everyone.
Thank you.